Welcome to this session of the Papaya Academy. I'm Amit Levy, Chief Product Officer here at Papaya Global. When we talk to companies managing a contingent workforce, we hear the same story repeatedly. Flexibility is great until payments get involved. Suddenly, you have a fragmented system, inconsistent processes, and way too many spreadsheets. So what should be a growth enabler becomes a massive operational burden. That's exactly what we'll unpack in today's session on contingent workforce payment strategies. We'll cover how companies engage contingent workers, how contingent workers are paid, the challenges of invoicing in multiple countries, local payment methods, handling taxes and statutory deductions, and uncovering the hidden costs. So let's get going. As mentioned in our other courses, companies usually hire contingent workers in a few ways. By direct engagement, such as from an internal referrals or retirees, business process outsourcing to another company, or indirectly, using a staffing agency, managed service provider, agent of record, and employer of record. The key here is understanding who's the worker's legal employer. Let's get into the details. If you engage a contractor directly, your company pays them like any other B2B vendor. The contractor sends an invoice, maybe monthly or per project, and you pay it through accounts payable. The frequency is whatever you agree to on the contract. This can create significant legal and reputational risks if done incorrectly. If you use a staffing agency or a BPO, typically the agency runs payroll for the worker on their side. The agency invoices you, and their bill rate includes all the necessary benefits and taxes. The payment flow is you pay the third party, an agency or a BPO, and they pay the worker. The frequency is usually whatever is locally appropriate and in line with your engagement model. With an MSP managing multiple vendors, payments work in a few ways. In most cases, the MSP consolidates billing and distributes the funds to the supplier partners. In others, each underlying vendor may invoice the program separately for their workers, and the MSP just oversees the process. With AORs and EURs, usually they capture the worker's time, and you pay them via an invoice. From there, they pay the worker on your behalf to an agreed schedule. One critical thing to manage is payment frequency mismatches. Your internal payroll for your employees might be bi-weekly or monthly, but some contractors expect weekly payments. Other contractors are paid via a project milestone schedule, so you need to plan for that. Now, let's talk about the challenge of managing payments across multiple countries. Without a robust system, you might end up with dozens of invoices in different currencies every month. This creates several pain points, like local banking barriers, because paying a bill in a local currency often requires a local bank account. But opening local bank accounts in foreign countries is extremely difficult for outsiders. It often requires high deposits and heaps of documentation. Then you have cross-border payments issues. Did you know that international wire fees of $20 to $50 per transactions are very common? Also, hidden FX costs can add 2 to 5% in transaction costs. These costs are sometimes put on contractors, and that takes up a big part of their paychecks. As for late payments, cross-border wires can take several days. If you initiate payment on Monday, your contractor in Moldova might not see the money until Thursday or Friday, especially if routing through corresponding banks. If you're legally obliged to pay on a certain day, that means you might face serious issues. Another problem, funding multiple accounts are usually handled by companies creating local currency accounts in each region, Mexican pesos in a Mexican bank, or shillings in Kenya. But while this can expedite local payments, it's a treasury nightmare to monitor and fund. Providing flexibility in payment options is critical as you address the needs of a global program. And while we've been talking about paying through traditional banking process, regionally, there are many other important and popular payment methods that workers prefer and can easily access. For example, in Kenya, M-Pesa is a mobile, phone-based money transfer and banking service used by a huge portion of the population. It's common for wages to be paid via M-Pesa, especially for remote or informal workers. Banks may be far away and difficult to access. In the Philippines, many freelancers use services like PayPal or local e-wallets, GCash, Papaya, to receive international payments, because those can be quicker than bank wires. Direct bank deposits in PHP, Philippine peso, are great if you can do them, but not all foreign companies can easily deposit to a BPI or a BDO bank account. In Moldova, workers might prefer USD or Euro payments because the Moldovan leu is not a common trading currency. Some could have Romanian or EU bank account if they work across borders. When in doubt, consult with an expert or a partner who knows the local landscape. If you have gig workers in these places, asking what's the best way to pay you is crucial. Don't assume a bank deposit. Be willing to consider something else entirely. Even though contingent workers are not your regular employees, in many areas, you, as the end client, shares some accountability in ensuring the appropriate taxes are paid. Here are a few scenarios. If workers are employees of an EUR, service provider, or staffing firms, the employer entity is primarily responsible for withholding income taxes, social contributions, and any other benefits. That being said, your organization is often considered a joint employer for these workers, and in the end, you retain some accountability. Ensure the contract clarifies these components and confirm that they are being done in a compliant manner. If workers are classified as independent contractors, aka solo self-employed, they essentially are a small business and as such are responsible for their own tax and benefits. You pay them gross and they handle their income tax, pension, etc. But you have to be careful. IC classification is a complicated and nuanced process, and if done incorrectly, can create tremendous liability for you. In some cases, misclassification is considered a criminal offense. Additionally, some countries impose withholding tax on payments to contractors or foreign service providers, like India, for example. Split payments to authorities. In some areas, you might need to withhold 5% or even more of the payment to the tax authority and split it. Part goes to the tax authority and part goes to the worker. For example, in Mexico, Brazil, Kenya, and other countries, the hiring company must split each invoice for an independent contractor. Part goes straight to the local tax authority and the balance to the worker. This complicates manual payments. It might require setting up the government as a payee in your system and ensuring references line up so the contractor gets credit. Have you ever had an employee ask, "Can you split my paycheck? Send 70% to my checking and 30% to my saving account?" In many regions, and in a regular payroll, this is a common occurrence. And in the contingent world, similar needs arise. A contractor might want part of their fee to go directly to different bank accounts or currencies. From the company side, you might also have to split payments, if, as mentioned, you must pay an authority portion directly. Manually doing split payments means multiple transactions for one worker pay, which is extra work and added chances for error. Modern payroll systems handle it easily for employees. But if you're using your standard AP for contractors, you might not have a built-in way. Throughout this talk, a theme should be emerging. How you pay contingent workers has direct impact on whether they want to continue working with you. Failure to do so correctly carries real risks and very unpleasant consequences. Independent workers are often highly skilled and in demand, and will be quick to walk away if admin issues pile up. A payment survey reports that 73% of independent contractors would leave their current freelance platform or client for one with a better payment experience. Engaging people is a costly process, regardless of where they are in the world. In addition to direct pay, there are other elements of cost to consider. Here are a few highlights. Agency markups. If you source workers through a staffing agency, in addition to the worker pay, you're paying a markup. This number is meant to cover all the staffing firm expenses and mandatory taxes, as well as its profit. It's important to understand your program markups, understand how your usage may affect your provider cost structure. Work collaboratively with your partners to address any bottleneck that may affect cost, and consider rebidding for the service if it's out of line. Currency exchange and banking fees. A bad FX rate is essentially a hidden cost. Additionally, a $25 or a $50 wire fee can add up if you multiply it by hundreds of payments and pay cycles. Those overheads should be quantified as part of your contingent labor cost. And if transferred to the contractor, they won't be very happy. Management overhead. Are you using managerial time inefficiently to coordinate contractors? If a project manager spends 10% of their time chasing invoices or resolving pay issues, remember that's part of your contingent labor cost. Technology fees can add hidden costs. Platform and other transaction fees can add up. This course provided a solid introduction to paying your contingent workforce. I hope you enjoyed it.